Well, it's been a strong start to the year for risk assets, with equities rallying across the board and European stocks having their best 2 weeks to start the year on record. Consensus expectations are getting torn up across the board, with US activity data coming in softer than expected, China reopening rapidly, and European economic figures proving resilient. That's all leading to central bank expectations being shaken up as a Fed downshift looms and the ECB continue to up the hawkish ante, which gives me and Ryan Littlestone plenty to discuss on this debut episode of the Trade-Off UK. Let's get into it. Well, as I said in the introduction, it's been an interesting, exciting and volatile start to the year, and risk on primarily. Let's bring in my co-host from Forex Flow Live and Forex Analytics. Ryan, how are you doing on this incredibly cold afternoon?
Yeah, afternoon, Michael. I nearly turned up in a scarf and woolly hat from the office. It is a nippy one, let's put it that way.
It really is. It really is. I was down by Bank Roundabout where your background is earlier on, and it was absolutely freezing out there. I must say the city is very, very quiet indeed today, and I don't blame people for staying at home. But without further ado, we've got plenty to get into on the show today, so let's get into Topical Thunder. So, as I said in the introductory piece, the start of the year has really seen the consensus expectations for 2023 pretty much torn up. And I know we were messing around about this on Twitter towards the tail end of last week, Ryan. It kind of shows that a lot of forecasts aren't really worth the paper that they're written on, because everyone came into the year expecting that the US would fare relatively well and probably avoid a recession, that Europe would see a recession in the first half of the year and then struggle to get out of it as the year progressed, and that the Fed would continue raising rates for quite some time while the ECB would be forced to back off a little bit. But hasn't quite happened like that, has it?
No, it hasn't. And some of the headlines or the titles of these new bank pieces, showing that, I think it was ING basically admitted they were ripping up their euro-dollar forecasts. A lot of banks doing the same. That tends to ask the question, what's the point of bank forecasts?
Exactly.
You can't sit behind your forecast for longer than 5 minutes. It's a bit pointless doing it. But as I'm sure our viewers will know, when we forecast things on the show, it's going to have a little bit more backbone to it, shall we say.
Well, I'd certainly hope so. And I certainly hope the forecasts that we make in this series are going to last significantly longer than the kind of 16 days that the consensus for 2023 managed to last before the whole street tore up their expectations. I think it does show for me, though, the importance of being nimble and being able to react to changing market conditions. We both rightly mock what the investment banks have done in terms of shifting those expectations so quickly. But actually, data has consistently come in better than expected in Europe, and it's consistently come in worse than expected in the States. So perhaps it's the logical thing to be doing to start reassessing those views. But I must say, I am very surprised by how resilient the Eurozone economy has proved, and the extent of the rally that's caused in European assets. Yeah,
definitely. And, you've got to ask the question. Obviously, a lot of the market got very bearish over Europe. Obviously, the Ukraine situation coming into winter, those gas supplies and moving away from Russian energy supplies. So maybe the market went a bit too far with their expectations of how bad things can get. I don't think we're out of the woods by any means. I think there's still maybe some difficulties to come for Europe, particularly as these rate hikes start biting in the next over the next course, a few months or 1 or 2 quarters. But definitely, I think regarding bank forecasting, you make the point. As retail traders, we have the ability to change much quicker. We don't need to make forecasts. I don't need to know what's going to happen in a year's time to trade euro dollar this morning. I am more of a fundamental trader. So, yeah, I do have a fundamental picture that may be 6-12 months away. But you're right. And it's going to be a question that needs to be asked from all sides of the globe. What happens in these first early quarters of the new year? Are we going to see recessions dipping? Is the data going to hold up? Are rate hikes going to catch up with the ECB and the economy moving forward?
Yeah, most definitely. I think the impact of cumulative tightening, as we would call it, is certainly a big theme on my radar through the first kind of couple of quarters of this year. One place that hasn't seen, well, any tightening really just yet is Japan. I know you wanted to talk about the Bank of Japan next.
Yeah, well, that's been another big subject. Coming into the end of the year, we had that surprise change in yield curve control. And before we get on to that, I want to say well done for your call on our preliminary meeting that we had earlier, about 4 weeks ago, that little tester we did for this show where you called Aussie yen down to 87.5 and it got pretty much all the way down to 87. So,
well, even the broken clock is right twice a day, I suppose, isn't it?
But no, you got that nailed on. And, I think now coming into this new year, we're maybe at a bit of a pause in terms of the market's expectations for the Bank of Japan. We've come a long way. You only need to look at any dollar yen chart to see that we've come down quite significantly, particularly in dollar yen. And that's, been a mix, as it was on the way up, of what the Bank of Japan's doing, what the US are doing. But as far as the Bank of Japan's going, they made that change to the yield curve control. The market has got the bone firmly in its mouth that there is changes afoot at the Bank of Japan. They're going to need to step into a tightening cycle. And it's the scale of that I think is going to give us the next kicker. We've got lots to happen over the months ahead. We've got the wage negotiations to come. We've got the changing of Kuroda. We may get that next month. The end of the fiscal year, when a lot of forecasts are made by the big whales over there, what they're going to do. They're going to go FX hedged, unhedged. A lot of flows happen around that time of year. But I think when you're talking just in now, I think particularly for yen pairs, we're going to see a bit of a pause perhaps just for now until we get something more in the BOJ picture.
Yeah, I tend to agree with you on that. I think the sort of hawkish BOJ story has almost been stopped in its tracks by the meeting last week. Obviously, markets came into that BOJ with very, very lofty expectations that we would see a surprise, really, in terms of a widening of that yield curve control band. Obviously, that didn't happen. And I think really that's led JPY bulls to kind of reassess the situation and probably wait until we get the announcement of the new BOJ governor, because it is probably going to be that new governor when they take office in April to actually deliver any sort of policy tightening or further tweaks to YCC or even a rate hike. So I think I'm with you on that one. I think the yen could tread water and just plod along for a little while until we get some new news out of the BOJ on who will be succeeding Kuroda when his term is up at the end of, or at the start of April, I should say. One thing that is moving markets in the here and now, though, is earnings, and they haven't been particularly good thus far. Around 65-66% of reports that we've seen of the S&P 500 constituents so far have beaten expectations. That sounds like it's good, but it's actually about 10 or 12% below the 5-year average. And I think what's important also is the commentary that we're seeing from these companies reporting earnings. It is not good. It is clear that inflation is starting to bite, not only in terms of margins, but also in terms of consumer demand. And of course, sticking with the kind of broader corporate affairs story, you're starting to see layoffs mount as well. Firstly, it was the big tech names, Amazon, Microsoft, Google, laying people off, 10, 20,000 people apiece. We've then started to see that spreading into the banks, obviously Goldman with a big round of layoffs, but I think it was one of their largest round of layoffs on record. And we're starting to see those job losses seep into other areas of the economy. So perhaps earnings are a little bit of a perfect storm for the market at the moment. The results themselves aren't coming in great. The commentary is pretty grim as well. And the layoffs that are coming along with it as companies try and cut costs. Yes, it may be boosting share prices in the near term, but I think it doesn't bode particularly well for the jobs market in the near term. And maybe we even get a negative non-farm payrolls print at some point during the first quarter.
Well, I think that's an interesting point. But I want to put some context on those jobs numbers because, we're seeing a lot of headlines flashing across the wires, such and such has cut this and so-and-so's cutting that. And it's Amazon, it's Google, it's Microsoft. Today Spotify cutting 6% of its workforce. And what I did this morning, I looked at some of the numbers to see how they are in context. Now, take Amazon. I think they cut something like 18,000 jobs, or going to cut 18,000 jobs. They employ 1.5 million people. The similar with Google. They employ over 100,000 people. And so these cuts, while they sound big on the headline front, Spotify, they employ around 7,000 people. So that's 350 jobs they're looking to cut.
Yeah.
All these numbers, 10, 12, 18s, the moment they're just adding up to sort of 1 month's NFP. Take a 200,000 NFP. All these cuts are adding up to around that mark. So right now, is that going to impact the jobs market? It's big on the headlines. It's big news for stock traders. But when you look at the actual numbers, if Google were cutting 40% of their workforce, that's a different story. Same with Amazon. Then you're getting into the hundreds of thousands. So although we are seeing these job headlines coming across, I don't think it's anything to worry about just yet. I'm not sure it's going to impact something like the NFP just now, because, as I say, the numbers aren't huge. They're not massive. What's more, I think, might be an effect for the NFP, and particularly this next reading we're going to get, is the weather that we had in the US. All these storms going through. We've had prior years where the weather's had an effect on reporting and getting the numbers in, getting the counts done. So that might be something that we need to factor in more for the next NFP report, rather than all these job cuts.
That's a very, very good point. And what about the US economy more broadly? I know you wanted to discuss that.
Yeah, the US economy, I think we're going to be trading this soft landing, hard landing business that we're talking about. And we have seen the US data looking pretty bad. The PMI is absolutely terrible, well into contraction. And some people, don't like these diffusion indexes, but, that's what we've got and that's what we trade. And it's not looking pretty. It's starting to spread, as you say, between the sectors. And you look at those numbers, you think, it's got to be a crash landing for the US. But then, like you point out, the jobs market is still strong. And you read the comments in the ISM, there's people still looking for skilled labour. But what I had picked up in some of those last ISM comments were that perhaps we're on a bit of a precipice, a bit of a tightrope between people employing more because they've got the orders, and now perhaps those orders are dipping back. There's less need to look for that employment. So this first quarter may be where we do start to see the jobs market maybe turning down a little bit, because people aren't looking for as many staff now because there's a bit of a downturn. And then from that, maybe the second half part of the year, we start to see some big job losses coming in.
Yeah, I think it's an interesting one. I mean, I've said for quite some time now that the sort of the path to a soft landing is almost so narrow that you can barely see it. I think it's very unlikely that the Fed will be able to get rates to 5.5% and end up engineering a very, very gentle slowing in economic activity and a very modest rise in unemployment. But I would love to be proved wrong on that for the sake of the US economy and the US worker. I guess the broader point I would make, and we're both well aware of this, is that the labour market is often the last to go when it comes to rate hikes and the last to really feel the impact of policy tightening. If you look at housing data, that's softening very, very rapidly indeed. Those PMI numbers that you mentioned are grim. I don't think there's really any other word for it. And then you've also got consumer spending is really starting to roll over as well. That December retail sales print was not particularly pretty. So I'm firmly in the hard landing camp, unfortunately, being a bit of a pessimist in our debut episode. Gun to your head, Ryan, hard or soft landing?
I'm going to go soft. I think they can hold up.
Well, there we go. A little bit of disagreement early doors. In that case, let's move on to That's a Setup. Well, I think a little bit of healthy disagreement is always good. It takes two to make a market, as they say. The market that I want to look at first in this section is the S&P 500, keeping things nice and simple to kick things off. And if we look back at this chart, which goes all the way back to January of 2022, and the S&P 500, as we know, has been in a bear market now for well over a year. And I think it's actually relatively simple. This one, you've got a trend line in place that's joined all of those lower lows pretty much since the start of last year. And on a closing basis, the bulls have not been able to get us to close above that level. And I think all of the time that the bulls are really failing to cement their place in the driving seat, and all of the time that these rallies are being sold into very quickly and very aggressively, particularly when the macro backdrop is not great and the incoming economic news continues to get worse. The market doesn't look to have priced in an earnings recession yet either. I really struggle to be bullish on US equities at the moment. I don't know about you.
Yeah, I think you're in the same camp as a lot of people. I think this was one of those times
that worries me when a lot of people agree with it.
Yeah, well, indeed. I mean, it might be one of these times, I say, where, I might have been better off going with the herd because, in our room, the world and his mate were looking for selling S&P up into that 4,000 area. And, the techs have stood up for the count. We've got up there, just around the 40s or 4,000s. And it's come back down afterwards. I think, the market, particularly with indices, we've had the bulls who were buying the dip for donkey's years. And now the rally sellers are taking control and they're saying, fine, you want to buy it up, we're happy to hit it when it gets to the chosen levels we like.
Exactly.
I think longer term, and what I'm looking for this early part of the year, I wanted to see if we're going to get a redefining of the risk narrative. Before, risk off has always been buy stocks because central banks are going to swing in like Batman and save your butt. But, if we are going to head for your hard landing scenario, if we are going to see the economy suffering, in which world is that now positive for stocks when there's not going to be a central bank backing you up with QE and cheap money, when rates are going to be higher? It's not going to be there. And I think the market's going to be making a bit of an adjustment to how it trades stocks moving forward, particularly regarding the data.
Yeah, I would agree with that one. I think the era of the central bank put that we had in place from 2008 to 2020, 2021, that is well and truly over, and it is a very, very different dynamic trading equities in an inflationary bear market compared to what we've seen before. So maybe is the yen a hedge then? I know you want to have a look at some JPY charts.
Yeah, definitely. And this is one I've traded on the short side. I was trading short on this one, even when it was rallying up to the 150s. I've been bearish this since probably about last October, just because I thought, the Fed trade, if you like, the hawkish side was getting a bit near its end. We knew where the ceiling was coming in. As we know, with trading currencies, it's all about the expectation of what a central bank will do, not necessarily what they do at that time.
Oh, most certainly.
So I've been bearish this, and I've been selling it, and in part all the way down. I'm in shorts at the moment. But going back to the Bank of Japan conversation and what we're talking about with the Fed, I can see we're potentially going to have a bit of period of consolidation, perhaps with this one. 127 was a big level we were looking at, highlighted, when we did that prior show. We got down there. 127.30 right on that fib level you can see there, and then it sort of stepped up. It got down into 127 again, but it stepped up that low, and for now it's saying we're not going any further than these lows. Now naturally, if it isn't going down, there's only other one way it can go, and it's going to go up. So from now I've drawn sort of a little box there. This is the range I'm expecting dollar yen to go into and maybe consolidate in moving forward. So the top end of that sort of coming in around that 134.50 area, that prior high that we got up there. I want to see what it does on the upside from here. If we get up to sort of 133s, I'll be adding to shorts, maybe that 134 area as well. See what the Fed does in 9 days or so time, beginning of February, because that's going to be a potential, big kicker for this pair. It's either going to give us better levels for me to short anyway, up towards the top end of that range if they're hawkish. Conversely, if they're not, if they're going to say we're worried about the data, we're slowing down hikes, we could be looking at pausing sooner. This may be going all the way back down again.
Yeah, definitely. The other thing I would be looking at in terms of dollar yen is where treasuries are going. The 10-year treasury doesn't really seem to be showing much desire to spend particularly long below 3.4% at the moment. And that is helping to keep a bit of a bottom in place in dollar yen. But as you say, I think we may be on a bit of a kind of random walk within that box you've drawn until the next Fed meeting. Speaking of the Fed, there's been a bit of divergence between, pretty much everything on either side of the Atlantic. Now, this is not a technical chart, and people who don't like overlay charts, then look away now, because this is going to be your worst nightmare. But what we're looking at here, and actually, may I just say, this overlay works, unlike those produced by a certain Scandinavian bank, quite frankly. Some people know.
Now, don't make enemies in your first show.
What we're looking at here is what are called City Economic Surprise Indices. And these put together, unsurprisingly, by Citibank. And they measure the degree to which data is coming in either better than expected or worse than expected. And the more positive the index reads, the more upside surprises we're getting, and the greater the degree of those upside surprises. And similarly to the downside, the more negative we are, the greater the magnitude of the downside surprises. And you don't need to be a macroeconomist to work out what this chart is telling you. Quite simply, the blue line is going higher and higher and higher, and that represents European data surprising consistently and to a greater magnitude to the upside. And the white line, which represents the US, is heading in totally the opposite direction. In fact, the difference or the spread between the economic surprises, the relative surprise in the Eurozone and in the US, is now at its widest since around Q2 of 2021. And I think you've got to consider not only the data divergence, but also the monetary policy divergence that will lead to. And I think that's only going to result in upward pressure on the euro, and also a continued rotation out of US equities and into equities in Europe and also in other parts of the world, because these surprise indices are compiled for pretty much every economy, and you're seeing this divergence pretty much everywhere. So this sell US, buy Europe, buy rest of the world theme, I think it's got some fairly serious legs to run for quite some time to come.
Yeah, I think so too. But we're talking about the Eurozone, and there's always a bombshell waiting in the wings with the Eurozone. We've got to remember how many countries are in there. Germany, they're always the growth engine, if you like. But it's been surprising that it's been countries like Spain and Italy that have really maybe led a lot of this. And so you've got to think, if there is problems, that's likely where they're going to show up first. But a question I'd have for you then is, we're not going to get this divergence forever. No. The ECB are likely, if they're to be believed and the Fed are to be believed, the ECB aren't going to get rates as high as the Fed. How does that leave the divergence trade then between the Fed and the ECB? If the Feds get into 5.25, the ECB maybe get into 4.5 perhaps before they go on pause and look to come back down to neutral. How's that going to play in the divergence trade? Or is it going to be how the economies are doing at the time?
Well, it's a very good question. And you're right. I feel a little bit nervous being bullish and long the euro. It's not a position that I ever really like to be in or ever really take on. Yeah, exactly that. And it's not just under these lights, I tell you. I think the market is going to focus on growth dynamics for quite some time to come. And I think the Eurozone avoiding a recession this winter as the US looks set to slide into a slowdown, I think that gives a little bit of fuel for this to continue for quite some time to come. But speaking of the US, let's have a look at the US, and rather than the divergence with Europe, let's have a look at the divergence with China.
Yeah, well, this is one I trade a lot, and the reason why I like to trade it a lot is because it can be very good technically. It can be very clear, particularly as far as the PBOC are concerned. If we get a strong move in this currency and they say they've had enough, they'll come out quite strongly and by the Chinese press and say, yen weakness, one weakness isn't going to be a one-way street forever. And those sort of comments give you an out, if you like, because if they start speaking like that, then if you're in a trade and that goes against them, this is one central bank you don't want to be fighting. But this is a setup that I've been looking at for the last week or so. We've got some very strong resistance that's shown up over the last few days, around about this 678, 79 area. And the price is really banging its head against it. And it's, as you can see from the chart, it's been historical support and resistance point as well. Now, obviously, we're in Chinese New Year, so markets are closed, and maybe there's a little bit of an official hand in this, just keeping things nice and calm through the holiday period. But I'm looking at this one for a potential break trade, because if we get a level that holds for a long time and we don't move too far away from it, price action being key, the experience that I've got, I tend to think if we get a break, it could be quite significant. So I'm personally setting up with a couple of stops just above the 679. If we do get a break up, I think we could have some legs, maybe 684, maybe even 690. So that's what I'm looking at over the next few days anyway.
Well, that could be a very chunky move indeed. I think, as you say, we might have to wait for Chinese New Year to be out of the way. But I will defer to your expertise on this one, because I must admit that CNH and CNY are not pairs I pay particularly close attention to. Perhaps remiss of me, and certainly something that I'll be keeping on the radar over the coming weeks. But let's finally move into some actionable setups for you all in our play of the day. So what I want to look at in my play of the day is cable. Now, cable is at a very interesting juncture at the moment, and I've got to preface this really by saying that I'm not really particularly bullish on sterling. If you were to sit there and write out a kind of bullet point list of all the bullish and bearish factors influencing a currency, I think the bullish column would be pretty barren when it comes to sterling. There's probably 1, maybe 2 points that you can put in there, given the rather grim economic situation. But we're at an interesting level nonetheless, despite that. We're coming up against this kind of 124.45 50 region, which we got to in December, and the rally sellers came in relatively quickly and actually took us all the way back below the 200-day moving average once more. But I'm just starting to wonder whether this time might be a little bit different. I know we've backed off from this level on our first attempt in early trade this week, but compared to where we were at the sort of tail end of last year, or when we last got to this region, it looks like the tide on the dollar seems to be turning. At that point, markets weren't expecting quite as aggressive a downshift out of the Fed. They weren't expecting economic data to sour quite as significantly as it has done in the States. And I'm just starting to wonder, really, whether if cable can sort of ride on the coattails of other G10s and this broad-based dollar weakness that we're seeing, and the bulls really can get a closing break of this 124.50 level, then I think that will at least see us take us above 125, and perhaps, just perhaps, and I do have a little bit of home bias in this, of course, perhaps set the stage for a continuation of sterling's solid trend this year. It is the best performing G10 currency year to date. There aren't that many longs in the market, so if we do start to get a bit of momentum behind this bullish impetus, just perhaps we might see a little bit of upside and a good year for the pound, in contrast to it being beaten up so much as it has been in the last couple of years. Ryan, what's your play of the day?
My play of the day is euro dollar. Interesting level we've got here. That blue zone you can see there.
Oh, with thumbs.
Yeah, you got some thumbs up and thumbs down. Yeah, whichever way it's going to go. Yeah, this 108.30.70 zone is a big historical level. Goes all the way back to into 2018 and way further back. It's one of those technical areas that becomes ingrained in the back of your mind. When you get to it, you always think, right, are we going to get some action here? And as you can see there, it's played out all the way through the last week or so. 108.70 is resistance, 108.30 becomes support, then it breaks, then it's resistance, up and down. The market didn't know what it wanted to do. Now, we had the break today, got above 109 and the fib level there, but it's failed again. So it's not quite ready to move on up. It's also failed at the 108.70. So what I'm looking at from this one is if we hold this 108.30 and maybe just push it down to the 108 big figure there, if we hold that area, that keeps the potential for a break higher in play. So my trade is perhaps a look at longs at 108.30 down to 108. If we're under 108, sort of 108, 107.80, break below there, then perhaps we're heading lower. But otherwise, I'm looking for this one to continue up.
Good stuff. An interesting idea there. We'll certainly revisit these calls next week. And I think we might also need to keep a bit of a record of these and see if we end up having a bit of a better track record than our counterparts in Melbourne and Arizona, respectively. And we'll see who comes out on top towards the tail end of the year. I'd certainly be putting some money on us. Anyway, that's all we got time for this week. I would just say, actually, TraderX.com, where this show is being hosted, we've got a whole host of content coming out this week. This isn't the only debut show that we've got this week, so keep your eyes peeled on that site. I won't say anything more at the moment, but something very exciting coming a little bit later on in the week to TraderX.com, as well as the trade-off, of course. Ryan, thank you very much for joining me this week, and look forward to doing it all again this time next week. Thanks for watching, and goodbye for now.